Before we begin, it's crucial to understand that the content in this presentation is for educational and informational purposes only. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. This video is not financial advice, and I am not a financial advisor. All decisions you make are your own sole responsibility. Let's be honest. If you're a trader in the United States, you've felt the frustration. You see traders in Europe or Asia talking about brokers with incredible features, super tight spreads, and a massive range of assets. You get excited, you go to their website, and then you see the 5 words every US trader dreads: not available in your region. It feels like being invited to a massive global party. A party where over $7 trillion are exchanged every single day. But when you get to the door, the bouncer just shakes his head. It's a uniquely American problem in the world of retail Forex trading. The regulatory landscape here is different, stricter, and because of that, our choices are significantly more limited. You're left with a handful of options and you're forced to wonder, are any of these actually good? Are they secure? Do they have the tools I actually need to execute my strategy? Or am I settling for a clunky, outdated platform just because it's one of the only ones available? This uncertainty, this lack of clarity, is exactly why this video series exists. This isn't a 5-minute quick look or a sponsored ad that just skims the surface. This is a complete, A to Z deep dive walkthrough of the OANDA platform, built from the ground up, specifically for the United States trader. My goal is to give you radical clarity. By the end of this series, you won't just know if OANDA is right for you. You'll know how to use it inside and out. We will cover everything, from the absolute basics of opening and funding an account, to navigating the web platform, placing your first trade, setting up your charts with advanced indicators, and even exploring its powerful mobile app for trading on the go. We're going to break down the fee structure, explain the different account types, and show you how to leverage powerful integrations like TradingView directly on the platform. We will leave no stone unturned. By the end, you'll be able to make a truly informed decision, and if you do choose to use the platform, you'll be able to operate it with absolute confidence from day one. So, the first big question is, why OANDA? Out of the few regulated choices we have in the US, why dedicate an entire in-depth series to this one? The answer lies in its unique history and its position within the US market. OANDA isn't some new startup trying to make a quick buck. They've been around since 1996. To put that in perspective, that's before Google was even a company. They were a pioneer in online trading. The company was co-founded by a computer scientist, Dr. Michael Stum, and an economist, Dr. Richard Olson. This is a critical point. From its very inception, OANDA's DNA was a fusion of technology and economic data. They were one of the first companies to provide comprehensive, real-time currency exchange rate information over the internet for free. Their entire philosophy was built on the idea of using technology to bring transparency and accessibility to a market that was historically opaque and reserved for large financial institutions. This history matters because it informs the platform you see today. But what matters even more, especially for us here in the US, is regulation. OANDA is regulated in the United States by the Commodity Futures Trading Commission, or CFTC, and is a member of the National Futures Association, the NFA. These aren't just acronyms to gloss over. They are your shield. The CFTC and NFA are the top-tier regulatory bodies in the United States, imposing some of the strictest rules in the world on brokers. They enforce rules about capital requirements, ensuring the broker is financially stable. They mandate transparent pricing and fair execution of trades. They require strict anti-money laundering procedures. For a broker to operate under this regulatory umbrella means they have met an incredibly high bar for security, transparency, and ethical conduct. This is arguably the single most important factor when choosing a broker in the US, because it provides a layer of protection that is simply not present with offshore, unregulated entities. Now, when you first approach OANDA as a new user, one of the first things you'll discover is that you have a choice to make. They don't just offer one single trading experience. They offer 2 distinct platforms for their US clients. First, there's their own proprietary platform, which they call OANDA Trade. This is the platform they built themselves. It's accessible via a web browser, and through their dedicated mobile apps for iOS and Android. This platform is generally known for its clean, user-friendly interface and its powerful integrated charting tools, which are powered by TradingView, a name that should be very familiar to any serious trader. We're going to spend a huge amount of time breaking down this web platform, showing you how to customize layouts, use the drawing tools, apply indicators, and manage your risk with different order types. But they also offer a second option, MetaTrader 4, or MT4. MT4 is the undisputed heavyweight champion of third-party trading platforms. It's been the global industry standard for years. While its interface might look a bit dated compared to newer platforms, its power lies in its massive ecosystem. MT4 is famous for its support for automated trading through what are called expert advisors, or EAs. There is a gigantic community of developers and traders who create and share custom indicators, scripts, and automated trading robots for MT4. So, if your strategy relies heavily on automation or specific custom tools that are only available on MT4, OANDA provides a gateway to use that platform while still being connected to their pricing and execution engine. This choice is significant. It means you aren't locked into one way of doing things. You can choose the sleek, modern, integrated experience of the OANDA trade platform, or the classic, customizable, and automation-friendly powerhouse that is MT4. We will be exploring both in this series, so you can clearly see the pros and cons of each, and decide which one aligns better with your personal trading style. Our mission throughout this journey is to cut through the noise. The world of trading is filled with complexity, jargon, and overwhelming interfaces. That confusion can lead to hesitation, and hesitation can lead to missed opportunities or costly mistakes. We're going to replace that confusion with competence. We will move methodically, step by step, starting with the absolute fundamentals and building up to the more advanced features. We'll look at the practical, real-world application of these tools. It's not just about knowing where a button is. It's about understanding what it does, why it's there, and how it can fit into a cohesive trading plan. This is your comprehensive guide, your roadmap to navigating one of the most established trading platforms available to us in the United States. So let's begin this process. Let's pull back the curtain and get started on building a foundational understanding of how this all works, starting with the very first decisions you'll need to make on the platform. The very first fork in the road you'll encounter isn't about which currency pair to trade or what chart indicator to use. It's a much more fundamental choice, and it dictates the entire nature of your initial experience. The choice is between a live account and a demo account. Now, this might sound simple, but understanding the profound difference between these two paths is one of the most critical first steps you can take. Think of the demo account as a multi-million-dollar, full-fidelity flight simulator. It has all the same controls, the same displays, the same feedback as a real Boeing 787. You can take off, fly through storms, practice complex landings, and even crash, all with zero real-world consequences. You get to learn the intricate mechanics of the machine, where the buttons are, what the levers do, how to read the instruments without risking a single thing. This is the sandbox. It's where you build muscle memory. You'll be using OANDA's platform with real-time market data. The prices you see are the real prices, moving in real time. The only difference is the money isn't real. It's virtual capital. This environment is invaluable for getting comfortable with the platform itself. How do you place an order? How do you set a stop loss? How do you close a position? These are mechanical questions, and it's far better to find the answers when a wrong click doesn't cost you real money. However, the flight simulator has one major deceptive flaw. You know deep down that you can't actually get hurt. And this is the psychological trap of the demo account. When you're trading with virtual money, there is no genuine fear of loss, and there's no exhilarating feeling of a genuine gain. The emotional component of trading, which many argue is over 80% of the challenge, is completely absent. You might take on huge risks you'd never dream of with your own capital. You might hold on to a losing trade far too long, thinking it's just fake money, it'll come back. These habits, learned in the sterile environment of a demo account, can be catastrophic when transferred to the real world. So while the demo account is an essential tool for learning the mechanics, it's a poor teacher for managing emotions. Then you have the live account. This isn't the simulator. This is the real airplane on a real runway with real passengers. Every decision has a tangible outcome. This is where you'll be using your own hard-earned capital. The process of opening a live account is by necessity more involved. Here in the United States, the Forex market is highly regulated by bodies like the CFTC and the NFA to protect consumers. So when you go to open a live account with a reputable broker like OANDA, they're required by law to ask you for certain information. This isn't them being nosy. It's them complying with federal regulations. You'll need to provide proof of identity, like a driver's license or passport, and proof of address, like a utility bill or bank statement. They'll also ask you a series of questions about your financial situation, your income, your net worth, and your trading experience. Again, this might feel intrusive, but it's part of a process called Know Your Customer, or KYC. It's designed to protect both you and the brokerage. They need to ensure you understand the risks involved. It's a sign that you're dealing with a broker who is playing by the rules, which is exactly what you want. Trading in a live account, even with a very small amount of money, flips a switch in your brain. Suddenly, that 1 pip move on the chart isn't just a flickering number. It's a real financial change. The emotional component comes roaring to life. The fear of losing money, the greed that comes with a winning trade, the anxiety of uncertainty. These are the real dragons a trader must learn to slay, and you only meet them in a live environment. So which path do you choose? The simulator or the real cockpit? The answer for many, and a path worth considering, is a hybrid approach. Start with the demo account. Spend a week, 2 weeks, whatever it takes to become completely fluent in the platform's mechanics. Learn how to place every type of order, how to customize your charts, and how to read your account statements. Practice until you're not thinking about how to do something but what you want to do. Once you've mastered the controls, then consider opening a live account, but, and this is key, funding it with a small, defined amount of capital that you are fully prepared to lose. This is your tuition money for the School of Real-World Trading. By trading small, you introduce the crucial element of real emotion without exposing yourself to significant financial risk. The goal isn't to make a fortune. The goal is to learn how you personally react when real money is on the line. Do you get scared and close winning trades too early? Do you get stubborn and let losing trades run too far? This is the self-knowledge you can't get from any book or any demo account. It's the beginning of your real trading education. Now, as you're going through the sign-up process, you'll face another important choice: which trading platform to use. OANDA gives U.S. clients a couple of options, primarily their own proprietary OANDA trade platform, available via web and mobile, and the globally recognized MetaTrader 4, or MT4. Let's break this down. Think of the OANDA trade platform as a modern, sleek, automatic transmission car. It's designed to be incredibly intuitive and user-friendly right out of the box. The charts are clean, the tools are integrated seamlessly, and everything is designed to work together perfectly within OANDA's ecosystem. For a new trader, this is often the path of least resistance. It allows you to focus on learning to trade, not learning to fight with complicated software. It has powerful charting tools, sophisticated order types, and everything you need to perform detailed analysis, all wrapped in a package that just makes sense. On the other hand, you have MetaTrader 4. If OANDA's platform is the modern automatic, MT4 is the legendary, time-tested manual transmission sports car. It's been the industry standard for well over a decade. It might look a little dated compared to newer platforms, and it might have a steeper learning curve, but its power lies in its massive global ecosystem. There are thousands upon thousands of custom indicators, scripts, and most importantly, automated trading strategies known as expert advisors or EAs that have been developed for MT4. It's the ultimate platform for customization and automation. If your long-term goal is to experiment with algorithmic trading, or to use a specific custom tool you found online, chances are it was built for MT4. So which one do you pick? There's no single right answer. It depends on your goals. My suggestion is this. If you are new to trading, start with the OANDA trade platform. The simplicity and intuitive design will allow you to get up and running faster. You can always open an MT4 account later if you decide you need its specialized capabilities. The beauty is you're not locked in forever. You can have both. You can use OANDA's platform for your analysis and manual trading, and you could use an MT4 account to test out an automated strategy. They are tools in your toolbox, and a good craftsperson knows which tool to use for the job at hand. So you've made the decision: demo versus live. You've navigated the application, understanding why each piece of information is required, and you've chosen your starting platform, the intuitive OANDA trade or the powerhouse MT4. Your account now exists. The foundation is laid. The door is open. Now we have to step inside. The next step is to fund this account and take our very first look at the main screen, the command center where all the action happens. We'll break down what every button, window, and number means, transforming it from an intimidating wall of data into your personal dashboard for navigating the markets. So let's start with the heart of the platform, the area your eyes will naturally gravitate towards, the rates panel. Think of this as your personal watch list or your market scanner. By default, it's populated with the major currency pairs, the heavy hitters of the Forex world like the euro versus the US dollar, or the British pound versus the Japanese yen. But this is your dashboard, and it should reflect what you want to track. Customizing this is one of the first steps to making the platform your own. You can add or remove instruments with just a few clicks, bringing in minor pairs, exotic currencies, or even commodities and indices if you're interested in those markets. Now look closely at any one of these pairs. You'll see two numbers constantly flickering, changing in real time. These are the bid and the ask prices. This is one of the most fundamental concepts, so let's make it crystal clear. The bid price is the price at which the market is willing to buy the base currency from you. The ask price, which is always slightly higher, is the price at which the market is willing to sell it to you. The small difference between these two prices is called the spread. Think of it like a currency exchange booth at the airport. They have a we buy price and a we sell price for every currency, and they're never the same. That difference is how the broker facilitates the transaction. Understanding this bid/ask dynamic is crucial because it's the landscape every single trade operates within. You'll always buy at the ask and sell at the bid. Right next to this rates panel, you'll typically find the largest and most dynamic window on the screen, the chart. If the rates panel is your watch list, the chart is your battlefield map. It's a visual story of a currency pair's price over time. The horizontal axis, the one at the bottom, represents time. This could be minutes, hours, days, or even months. The vertical axis on the right represents the price. The most common way this story is told is through something called candlesticks. Now, don't let the name intimidate you. The concept is actually quite simple and powerful. Each candle represents a single period of time. Let's say 1 hour. The thick part of the candle, called the body, tells you where the price opened at the beginning of that hour and where it closed at the end of it. If the body is green, it means the price closed higher than it opened. The price went up during that hour. If it's red, the price closed lower than it opened. Then you have the thin lines sticking out of the top and bottom called the wicks. These tell you the absolute highest and lowest points the price reached during that same 1 hour period. So in a single glance, one candle gives you 4 key pieces of information: the open, the close, the high, and the low for that time frame. When you string hundreds of these candles together, you get a rich, detailed picture of the market's behavior, its ebbs and flows, and the ongoing tug-of-war between buyers and sellers. One of the most powerful features here is the ability to change your time frame. You might be looking at a 1 hour chart, where each candle represents 60 minutes of activity. With a single click, you can switch to a 15-minute chart to see a more granular, zoomed-in view of the recent action. Or you can zoom out to a daily chart, where each candle represents an entire day, to see the broader long-term historical trend. Mastering the ability to look at the market through these different lenses is a key skill. It's like being able to switch from a satellite view of a forest to a magnifying glass examining a single leaf. Now, here's where the platform starts to feel connected. Go back to your rates panel and click on a different currency pair. Watch what happens to your chart. It instantly updates to show you the price history for the new pair you selected. This seamless interaction is key. The rates panel is for selection. The chart is for analysis. They work together, hand in glove. Let's move on to another critical area, usually found near the top or bottom of your screen, the account summary window. This is your personal scoreboard. It gives you a real-time snapshot of your account's financial health. There are a few key terms here. First, you have balance. This one's easy. It's the amount of money in your account before you have any open trades. It's your starting point. Next, you'll see equity. This is the most important number to watch. Equity is your balance plus or minus the profit or loss from your current open trades. If you have no trades open, your equity will equal your balance. But as soon as you open a position, your equity will start to fluctuate with the market. It's the real-time liquid value of your account at this very second. Then you have margin used and margin available. This concept can trip people up, but let's demystify it. When you trade with leverage, you don't have to put up the full value of the trade. Instead, you put up a small good faith deposit, which is called margin. Margin used shows you how much of your account's money is currently being held as a deposit for all your open positions. Margin available is the remaining amount of money you have left to open new positions. Think of it as your available trading power. It's vital to monitor this because you always want to have sufficient available margin to withstand market swings and avoid any forced liquidations, a scenario known as a margin call. Finally, in this summary, you'll see unrealized P/L, which stands for profit and loss. This shows the total profit or loss of all your open positions if you were to close them right now. It's called unrealized because you haven't locked it in yet. It's still floating, changing with every tick of the market. Once you close the trade, that profit or loss becomes realized and gets added to or subtracted from your account balance. The final piece of this main interface puzzle is usually a window at the bottom that has a few different tabs, often labeled Positions, Orders, and Trades. This is your active operations center. The Positions tab is your list of currently open trades. If you're currently long the euro versus the dollar, you'll see it listed here, along with the size of the position, the price you entered at, the current price, and your running unrealized profit or loss for that specific trade. This is your What's Happening Now screen. The Orders tab shows any pending instructions you've given the platform. For example, you might have placed an order to buy a currency pair only if it drops to a certain price, or an order to automatically close a position if it hits a specific profit target. These are your if-then instructions, waiting patiently for the market to meet your conditions. And the Trades or History tab is your logbook. It's a detailed record of every trade you've closed. It shows what you traded, when you opened it, when you closed it, and the final realized profit or loss. Analyzing this history is an incredibly valuable educational tool for understanding your own trading patterns and outcomes over time. So let's put it all together. Imagine a workflow. You scan your rates panel, looking for an interesting setup. You see one in the Australian dollar versus the US dollar. You click on it, and your chart instantly updates. You analyze the candlesticks across different time frames. You decide you see a potential opportunity. You glance at your account summary to confirm you have enough margin available. You decide to enter a trade. Once you do, that new trade immediately appears in your positions window. As the market moves, you watch the unrealized P/L on that position, and you see your overall account equity fluctuate in real time. It's a complete, interconnected ecosystem. Each window has a distinct purpose, but they all work in concert to give you a comprehensive view of both the market and your own activity within it. Taking the time to understand how each of these panels, the rates, the chart, the account summary, and the positions window, talk to each other is the foundation for navigating this platform with confidence. And that confidence is built not just by watching but by doing. So let's bridge the gap from passive observation to active participation. Let's walk through the single most important action you'll take on this platform: placing an order. This is the moment where analysis meets action. There are a few ways to get started. The most direct is right from the rates panel we just looked at. See the buy and sell prices for, let's say, euro to US dollar? Clicking either of these instantly brings up the order ticket, pre-filled with that currency pair. It's designed for speed and efficiency. Alternatively, if you're deep in analysis on a chart, you can often right-click directly on the chart itself to bring up trading options. This is a fantastic feature because it keeps you in the zone, focused on the price action without having to navigate away to a different panel. For now, let's stick with the rates panel. We'll click on the price for euro to US dollar, and pop, here is our order ticket. Now let's dissect this window. It might look a little intimidating at first, with all its numbers and options, but every single element here has a clear and distinct purpose. At the very top, you confirm your instrument, euro to US dollar in our case. Below that, you have the heart of your order, the units field. This is where you decide the size of your position. Now, what does 10,000 units actually mean? In the world of Forex, this is often referred to as a mini lot. Think of it as the quantity of the base currency, in this case euros, that you're looking to control. A smaller number, say 1,000 units, is a micro lot, and 100,000 units is a standard lot. The size you choose directly impacts the value of each pip movement, and consequently, your potential risk and reward on the trade. OANDA offers a high degree of flexibility here, allowing you to trade non-standard unit sizes, which is a key feature for traders wanting to manage their risk exposure with precision. The default order type you'll see is a market order. This is the simplest, most straightforward way to enter a trade. A market order says one thing and one thing only: get me into this position right now at the best available price. There's no negotiation, no waiting for a specific price. It's an order for immediate execution. When you're ready to act, you look at the two big buttons, sell and buy. Notice the prices inside them. That's the spread we talked about earlier presented in real time. The sell price is the bid, and the buy price is the ask. If your analysis leads you to believe the euro will strengthen against the dollar, you would be looking to buy. If you anticipate the euro will weaken, you'd be looking to sell. For our walkthrough, let's imagine we're bullish on the euro. We've set our units to 10,000. We click the blue buy button, and just like that, it's done. You'll get a confirmation that your order has been filled, almost instantaneously. But where did it go? Look down at your positions window. Instantly, a new line item appears. It shows the instrument, euro to US dollar, the number of units you're holding, the exact price you entered at, and a running profit or loss, which will fluctuate with every single tick of the market. This is your command center for live trades. You've officially gone from observer to participant. But placing the trade is only half the story. Honestly, it's the easy part. Managing the trade is where discipline and strategy truly come into play. Let's talk about two of the most critical tools at your disposal for this. Take profit and stop loss. These are your pre-planned exit strategies. The powerful thing is, you can set them before you even enter the trade. Let's rewind and look at the order ticket again, before we click buy. See these sections for take profit and stop loss? Think of these as your automated what-if instructions to the platform. A stop loss is your safety net. It's an order you place that says, if the market moves against me and reaches this specific price, close my position automatically to limit my potential losses. This is a fundamental concept in risk management for many traders. It allows you to decide beforehand the maximum potential loss you're willing to accept on this particular trade. You're not just hoping the market goes your way. You're defining the boundary of what happens if it doesn't. You can set this stop loss by a specific price level, by the number of pips away from your entry price, or even by a specific dollar amount of risk. On the flip side, you have the take profit order. This is your target. It says, if the market moves in my favor and hits this profitable price, close my position automatically and secure the potential gains. This is a tool for instilling discipline. It helps prevent a common emotional pitfall where a trader watches a winning trade turn into a losing one because they were hoping for just a little bit more. By setting a take profit, you've defined what a successful outcome for this trade looks like to you, before your emotions have a chance to enter the equation. So, you can enter a market order with your protective stop loss and your target take profit already attached. This is a complete trade plan, executed in a single click. But what if you don't want to enter the market at the current price? What if your strategy requires a bit more nuance? This is where we move beyond market orders and look at limit and stop orders. Let's go back to the top of our order ticket and click the drop-down menu where it says Market. You'll see other options, including limit. A limit order is essentially a get me a better price instruction. Let's say euro to US dollar is currently trading at 1.0850, but your analysis suggests that if it dips down to a support level at 1.0820, that would be a much stronger entry point. You can place a buy limit order at 1.0820. Your order will just sit there on the server waiting patiently. It will only execute if and when the market price drops to your specified level or lower. It's like telling your broker, I'm only interested in buying if I can get it on sale at this price or better. If the price never drops that low, your order never fills and you never enter the trade. A sell limit works the opposite way. You'd place it above the current market price, based on the idea of selling at a peak. Now let's look at the other type, the stop order. This one can be a little counterintuitive at first, but it's incredibly powerful for certain strategies. A buy stop order is placed above the current price, and a sell stop is placed below it. Why on earth would you want to buy at a higher price than what's available now? Traders often use this to enter a trade, only when the market shows strong momentum in their desired direction. Imagine there's a key resistance level, a price ceiling, at 1.0900. A trader might place a buy stop order at 1.0905. The logic is, if the price is strong enough to break through that ceiling at 1.0900, it likely has momentum to continue higher. I want to jump on board and ride that potential breakout. The order acts as a trigger. It does nothing as long as the price stays below 1.0905, but the moment the market touches that price, it converts into a market order and gets you into the trade. It's an order that executes only when the market confirms a certain level of strength or weakness by breaking through a key point you've identified. So, to recap, you have market orders for immediate execution at the current price. You have limit orders to try and enter at a more favorable price, buying a dip or selling a rally. And you have stop orders to enter on a confirmation of momentum like a breakout. For every single one of these entry types, you have the ability to predefine your exit strategy with a protective stop loss and a target take profit. Understanding the strategic difference between these order types is what elevates your interaction with the platform from simply clicking buttons to making informed, deliberate trading decisions. Each order type is a tool in your toolbox. Knowing which tool to use for which job is a skill developed through practice and studying the market. As you get comfortable with placing these different types of orders, the next logical step is to learn how to manage them once they're live in your positions window. How do you modify a stop loss if the trade moves in your favor? How do you partially close a position to lock in some gains? That's exactly where we'll dive in next. Let's tackle that first question. Modifying your stop loss while a trade is live. This isn't just a technical skill. It's a core part of dynamic trade management. The market is a living, breathing thing, and your plan needs to be able to adapt. You might want to move your stop loss to your entry point, what traders call moving to break even, to create a risk-free trade. Or as the price moves deeper into profit, you might want to trail your stop loss behind it, locking in gains as you go. Here in the positions window, you can see our live trade. To modify it, you don't need to go back to the chart. OANDA makes this incredibly simple. Look for the Modify button, often represented by a small pencil icon or a similar symbol right on the trade line itself. Clicking this opens up the Modify position ticket, and it should look very familiar. It's almost identical to the order ticket we used to enter the trade. Here you have direct control over your existing stop loss and take profit orders. You can see the current price levels they're set at. Let's say our trade has moved 25 pips in our favor. We decide we want to protect some of that. Our initial stop loss might be 30 pips below our entry. We could now modify it and move it to our exact entry price. To do this, you simply click into the stop loss field and type in the new price level. You'll notice, just like before, the platform helps you by showing the corresponding pip distance and the potential dollar loss if it were to hit. Once you've entered your new break-even price, you hit the Modify button, and that's it. Instantly, your order is updated on the server. You've just taken the risk off the table. If the market reverses and comes all the way back to your entry, you'll be closed out for a tiny loss or gain due to the spread, but your core capital is protected. It's a powerful feeling. The same process applies to your take profit. Maybe the market is showing incredible momentum, and you believe your initial profit target was too conservative. You can go right back into that same Modify position ticket, click on the Take Profit field, and set a new, higher price target to give the trade more room to run. Now, for the second question, which is a bit more advanced, partial closures. This is a technique traders use to manage risk and psychology simultaneously. The idea is to lock in a portion of your profits while leaving the rest of the position open to potentially capture a larger move. It's the best of both worlds. You're paying yourself for being right, but you're not cutting a winning trade-off at the knees. So how do you do this in OANDA? It's not a big, obvious button that says, close half. It's a bit more subtle, which is why many people miss it. On your open position line, you'll see a close button or a little X. You might think this will close the entire trade, and it will if you just click it and confirm. But we want to be more precise. When you click that close button, a new ticket pops up. This is the close trade ticket. And the most important field on this ticket is the amount, or units field. By default, it will be populated with the full size of your position. For example, if you opened a trade for 20,000 units, it will say 20,000. The secret to a partial close is to simply change that number. If you want to close half of your 20,000 unit position, you just edit that field to say 10,000. Then you hit the Close Trade button. Instantly, the platform will execute your command. It will close 10,000 units at the current market price, and that realized profit will be added to your account balance. Your original position will now be updated in the positions window, showing that it's now a 10,000 unit trade. Your original stop loss and take profit orders will remain active, but they now only apply to the remaining 10,000 units. You've successfully scaled out, banking a profit and reducing your overall exposure, all while keeping a horse in the race. This is a game changer for many traders' strategies. Building on the idea of dynamic management, let's talk about one of OANDA's most useful features, the trailing stop. A regular stop loss is static. You set it at a price and it stays there. A trailing stop is dynamic. It's designed to automatically follow the price as it moves in your favor, maintaining a fixed distance that you specify. Think of it like this: you go long on a currency pair, and you set a 30 pip trailing stop. If the price moves up 10 pips, your stop loss automatically moves up 10 pips with it, always staying 30 pips behind the highest point the price has reached since you opened the trade. If the price goes up 50 pips, your stop loss diligently follows, now 50 pips higher than where it started, locking in 20 pips of profit. The key is it never moves backward. If the price starts to retrace, the trailing stop holds its ground at its highest point. If the price then falls by the 30 pip distance you set, it will trigger and close your trade, securing whatever profit was locked in. To set this up, you go back to that same modify position ticket we used before. Next to the stop loss setting, you'll often find a checkbox or a drop-down for trailing stop. Once you enable it, you'll be asked to input the distance in pips. You set your desired distance, say 40 pips, hit modify, and the platform takes over. This automates the process of protecting profits, which can be incredibly useful in fast-moving markets or for traders who can't watch their screens every second. It's a set-it-and-forget-it way to let your winners run while systematically protecting your downside. All of this trade management activity directly impacts the numbers you see in your account summary window, and understanding these numbers is absolutely critical. Let's quickly break them down, because they tell the real-time story of your account's health. First, you have your balance. This is the amount of cash in your account. It only changes when you close a position and realize a profit or a loss, or when you make a deposit or withdrawal. It's your baseline. Next, and arguably more important, is equity. Your equity is your balance plus or minus the profit or loss of your current open positions. This is the real-time liquid value of your account if you were to close everything right now. If your balance is $10,000 and you have an open trade that's up $500, your equity is $10,500. This is the number that truly reflects your account's current standing. Then you have margin used or used margin. This is not a fee. This is the portion of your account equity that is set aside by the broker as collateral to keep your current positions open. The bigger your trades, the more margin is used. Margin available, or usable margin, is what's left over. It's your equity minus the used margin. This number tells you how much firepower you have left to open new positions. Watching this is crucial for avoiding a margin call. Finally, you have unrealized P/L, or floating P/L. This is the total profit or loss of all your open positions combined. It's called unrealized because it's not yours yet. It's theoretical money that only becomes real and gets added to your balance when you actually close the trades. Watching how these numbers interact is key. When you open a trade, you'll see your usable margin decrease. As that trade moves into profit, your unrealized P/L becomes positive and your equity grows. When you perform a partial close, you'll see a portion of that unrealized P/L turn into realized profit, and your balance will increase for the first time since opening the trade. Managing these individual trades is one thing, but understanding how they affect your overall account health in real time is what separates a novice from a seasoned trader. So now you know how to enter a trade, how to set your initial risk parameters, and how to dynamically manage that trade while it's live by modifying stops, taking partial profits, and even automating the process with trailing stops. But once a trade is closed, its life isn't over. Its real value is in the data it leaves behind. Every closed trade is a lesson. How do you access that history? How do you generate reports to find patterns in your trading? What are you doing right and what are you doing wrong? That's the science of performance analysis, and it's where we'll go next. The platform isn't just a gateway to the markets. It's a mirror. It reflects every decision, every hesitation, every victory, and every misstep. This mirror is found in your account history and activity reports, and learning to read it is one of the most critical skills you can develop. This isn't about dwelling on the past. It's about mining the past for intelligence to build a better future. So let's navigate to the reporting section. Typically found under your account summary or a dedicated reporting tab, this is your command center for historical data. OANDA provides a few key documents, and it's important to understand the role of each. First, you have the activity statement. Think of this as your account's monthly or quarterly financial report. It gives you the big picture. Your starting balance, your ending balance, total profits and losses, deposits, and withdrawals. It's the 30,000-foot view, perfect for tracking your overall progress over time. It answers the question, how did my account perform this month? But the real treasure is in the transaction report. If the activity statement is the headline, the transaction report is the deep dive investigative story. This document lists every single event that has occurred in your account. Every trade opened, every trade closed. It shows the exact entry price, the exit price, the time of execution down to the second, the commissions paid, and the overnight financing or swap that was credited or debited. This is the raw, unfiltered data of your trading life. And at first glance, it can look overwhelming, just a wall of numbers and text. But inside this wall of data are the blueprints to your trading habits, your strengths, and your weaknesses. This is where you become a data scientist with your own trading as the subject. So, how do you turn this raw data into actionable intelligence? Let's stop thinking like a trader for a moment and start thinking like a detective. Your mission is to find patterns, the modus operandi of your trading. The first step is to customize the date range. Don't just look at the last year. Look at the last week. Look at a specific month where you felt you were trading particularly well, or a month where nothing seemed to go right. By isolating these periods, you can perform a forensic analysis. Let's walk through a case study. Imagine you filter for the last 30 days and export the transaction report. Many platforms, including OANDA, allow you to export this data as a CSV file, which you can open in a spreadsheet program like Excel or Google Sheets. This is a game changer. Don't just view the report in a PDF. Export the data. Once it's in a spreadsheet, you can sort, filter, and calculate in ways you can't on the platform itself. Now, with your data in a spreadsheet, you create a few new columns. In one, you calculate the profit or loss for each individual trade. In another, you calculate the duration of each trade, how long it was open. Now, you sort the entire sheet by that profit and loss column from the biggest loser to the biggest winner. And a pattern might just jump off the page. You might notice your 10 biggest losing trades were held for an average of 3 days. But your 10 biggest winning trades? They were only held for an average of 4 hours. What does this tell you? It's a potential clue that you're cutting your winners short out of a fear of the profit disappearing, but you're letting your losers run, hoping, praying that they'll turn around. This is an incredibly common psychological trap. The market doesn't care about your hope, but the data, your transaction report, reveals this emotional bias with cold, hard numbers. Without this report, you might just have a vague feeling that things aren't working. With the report, you have a specific data-backed problem to solve, your risk management and trade management on losing positions. Let's try another angle. This time, you sort your trades by the instrument or the currency pair. You might discover that 80% of your profits came from trading euro to US dollar, but you consistently lost money on pound sterling to Japanese yen. Maybe the volatility of the pound-yen cross doesn't suit your strategy or your temperament. The data here isn't telling you to never trade pound sterling to Japanese yen again. It's presenting you with a choice. Either focus on your strength in euro to US dollar, or dedicate serious time to understanding why your approach fails with pound sterling to Japanese yen before committing more capital. This is how you refine your edge. The analysis can get even more granular. You can analyze the time of day. By looking at the timestamps of your trades, you might see that most of your losing trades were placed within the first hour of the New York market open, a notoriously volatile and difficult period to trade. Conversely, your most profitable trades might be happening during the calmer afternoon session. The insight is powerful. Your strategy might be perfectly fine, but you might be deploying it in the wrong market conditions for you. The solution could be as simple as avoiding that first hour until you have more experience. This process of review is what separates a disciplined approach from a gambling mindset. It's about creating a feedback loop. You trade, you generate data. You analyze the data, you gain insights. You use those insights to adjust your strategy, and then you trade again, creating new data. It's a cycle of continuous improvement, and you can take it even further by combining the platform's objective data with your own subjective data. If you keep a trading journal, and you absolutely should, you can cross-reference it with your transaction report. Let's say your report shows a huge losing trade on a Tuesday. You go to your journal entry for that day. It might say, "Felt rushed, entered the trade without full confirmation because I was afraid of missing out, broke my own rules." Now you have the full story. The report shows you what happened, a big loss. Your journal tells you why it happened, a psychological error, a fear of missing out. This combination is how you truly understand the driver behind your performance. Once you get comfortable with this level of analysis, you can start calculating more advanced performance metrics. Things like your profit factor, which is your total gross profit divided by your total gross loss. A profit factor of 2 means that for every dollar you lost, you made $2. Many traders aim to keep this number well above 1.5. Another metric is expectancy, which tells you what you can expect to make or lose on average per trade. You don't need to be a math wizard to do this. A simple spreadsheet formula can calculate it for you. Once you've exported your transaction history, these aren't just fancy numbers. They are objective measures of your strategy's effectiveness over a large sample size of trades. So the reporting tools within OANDA are not just for tax purposes. They are your personal performance coaching system. They are the honest friend who will tell you what you need to hear, not what you want to hear. They show you when you followed your plan and when you deviated. They highlight your strengths to build upon and expose your weaknesses to work on. Running these reports regularly, weekly or monthly, should be a non-negotiable part of your trading routine. It's the equivalent of a top athlete reviewing game tape to see what they did right and where they made mistakes. Every trade is a piece of tape. Your job is to be the coach. You've become a historian of your own trading. You've analyzed the past to find your edge, to understand your own psychology, and to spot the patterns that define your results. But how do you apply that edge to the future? How do you look at a blank chart and begin to build a case for your next trade? How do you identify potential levels of support and resistance, spot emerging trends, and use technical tools to refine your entry and exit points? That's where OANDA's advanced charting suite comes in, and it's the engine room we're exploring next. So let's open up the engine room, because a chart, when you really look at it, isn't just a bunch of random lines and bars. It's a story. It's the collective footprint of every buy and sell decision, every fear, every bit of greed, every news event, all visualized in real time. It's the language of the market, and OANDA's charting suite is your Rosetta Stone. The first thing you'll notice is the clean, uncluttered interface. This isn't an accident. In a world of constant information overload, focus is your most valuable asset. The platform is designed to put the price action front and center. You have your standard chart types, the simple line chart, which connects closing prices to give you a bird's eye view of the trend, the bar chart, which gives you the open, high, low, and close for each period, and of course, the most popular choice for most traders, candlestick charts. Each candlestick tells a miniature story within the larger narrative. The body of the candle shows you the distance between the open and closing price. If it closed higher than it opened, the candle is typically green or white, a story of bullish pressure in that period. If it closed lower, it's red or black, a story of bearish pressure. The thin lines sticking out, the wicks or shadows, tell you the full range of the battle, the absolute highest and lowest prices reached before the period ended. Learning to read these individual candles and the patterns they form is a foundational skill, and this platform gives you a crystal clear view to do just that. But which story are you reading? The story of the last hour, or the story of the last year? That's where timeframes come in. With a single click, you can zoom from a 1-minute chart, which looks like a chaotic, fast-paced action movie, all the way out to a weekly or monthly chart, which reads more like a slow-burning historical epic. A day trader might live on the 5-minute and 15-minute charts, looking for short-term opportunities. A swing trader might focus on the 4-hour and daily charts, aiming to capture moves that unfold over several days or weeks. OANDA makes switching between these perspectives seamless, allowing you to conduct top-down analysis, spotting the major trend on a higher time frame before zooming in to find precise entry points on a lower one. Now, once you have your chart and your time frame, it's time to start mapping the territory. This is where the drawing tools become your best friend. The most fundamental of these is the trend line. By connecting a series of higher lows in an uptrend, or lower highs in a downtrend, you're not just drawing a line. You're visualizing the market's momentum and creating a dynamic boundary of potential support or resistance. Speaking of which, the horizontal line tool is just as crucial. You can scroll back in time and mark the price levels where the market has previously pivoted, areas where a rally stalled and reversed, or where a sell-off found a floor and bounced. These historical battlegrounds between buyers and sellers can often remain relevant, acting as potential future areas of support or resistance. Drawing these levels on your chart is like a pilot marking key waypoints on a map before a flight. Then you have more advanced tools like Fibonacci retracements. This might sound complex, but the idea is simple. After a market makes a strong move in one direction, it often pulls back or retraces a portion of that move before continuing. The Fibonacci tool helps you measure the depth of that pullback, highlighting key potential levels like 38.2%, 50%, and 61.8%, where the market might find support and resume its trend. It's a way of trying to quantify the market's natural rhythm of ebb and flow. But what if you want to go deeper? What if you want to look under the hood of the price action? That's where technical indicators come in. Think of these as different lenses, each designed to highlight a specific aspect of market behavior that might not be obvious from looking at price alone. OANDA's platform is packed with them, but let's touch on a few of the most widely used. First, you have moving averages. A moving average does exactly what it says. It calculates the average price over a specific number of periods, say 20, 50, or 200, and plots it as a smooth, flowing line on your chart. Its primary job is to filter out the day-to-day noise and show you the underlying direction of the trend. A price trading above a rising 50-period moving average suggests a different market environment than one trading below a falling 50-period moving average. Traders also watch for crossovers, where a shorter-term, faster-moving average crosses above or below a longer-term, slower one, as this can sometimes indicate a potential shift in momentum. Next, there are oscillators like the Relative Strength Index or RSI. The RSI doesn't care about the absolute price level. It measures the speed and magnitude of recent price changes. It's plotted on a scale from 0 to 100. Traditional analysis often considers readings above 70 to be potentially overbought, and readings below 30 to be potentially oversold. This doesn't mean a market is guaranteed to reverse. An asset can stay overbought in a very strong uptrend for a long time. Rather, it's a tool for context, a gauge on the dashboard telling you how hot the engine is running. Then you have an indicator like the MACD, or Moving Average Convergence Divergence. This is a versatile tool that tries to capture trend and momentum. It consists of two lines, the MACD line and a signal line, and a histogram. When the MACD line crosses above the signal line, it's often interpreted as a bullish signal, and when it crosses below, a bearish one. The histogram visually represents the distance between these two lines, giving you a quick read on the strength of the momentum. A growing histogram suggests accelerating momentum, while a shrinking one suggests it's fading. Now, here's where OANDA truly elevates its offering. They understand that serious traders demand elite-level tools. That's why they integrated one of the most powerful and beloved charting platforms on the planet directly into their system, TradingView. This is a game-changer. By choosing the TradingView chart option within OANDA, you unlock an entire universe of advanced analytical capabilities. You're not just getting a few dozen standard indicators, you're getting access to the vast TradingView library, which includes thousands of community-built, custom indicators and scripts. Have a specific strategy you want to test that requires a unique combination of indicators? There's a good chance someone in the TradingView community has already built a script for it. This integration brings an unparalleled level of analytical depth and customization right into your OANDA workspace. The drawing tools are more advanced, the customization is deeper, and you're tapping into the collective intelligence of millions of traders worldwide, all without ever leaving your OANDA platform. It's like having a standard, reliable sedan, but then pressing a button that instantly upgrades it with the engine and dashboard of a Formula One car. Finally, none of this matters if you have to set it up from scratch every single time you log in. Workflow is everything. OANDA allows you to save your chart layouts and templates. You can spend time perfecting your workspace, arranging your charts, applying your preferred set of indicators with your specific settings, marking your key levels, and then save it. The next time you log in, your entire analytical cockpit is there, exactly as you left it, ready for you to get to work. You can create different templates for different strategies or different markets. This level of personalization turns the platform from a generic tool into your tool, tailored to your unique process. This suite of charting tools, from the basic to the profoundly advanced, forms the analytical heart of the OANDA platform. It's where you move from being a passive observer to an active analyst, deconstructing the market story, identifying patterns, and forming a thesis about what might happen next. But all this analysis is just preparation. The real test is execution. How do you translate your chart analysis into a live order with precision and control? From market orders to pending orders, that's the critical link we're forging next. And that's where the rubber meets the road. All the lines, indicators, and theories on your chart must ultimately be distilled into a single decisive action: the order. In the OANDA platform, this happens in the order ticket window, your command center for entering the market. Think of it less like a button and more like a surgeon's scalpel. Every input has a purpose. Every setting defines your strategy and your risk. When you first open that order ticket for a pair, say the euro to US dollar, you're presented with two big, bold numbers: the sell price and the buy price. That gap between them, that's the spread we talked about earlier. It's the cost of doing business. Your first decision is the most fundamental. Are you anticipating the price will go up or down? If you believe it's heading up, you're looking to buy. If you think it's going down, you're looking to sell. But before you click either of those, you have to decide on the size of your position. This is controlled by the units field. This is a critical concept. The number of units you trade directly determines the value of each pip movement and, therefore, the potential profit or loss on your trade. A smaller number of units means each pip is worth less, resulting in lower risk and lower potential reward. A larger number of units magnifies everything. This isn't a number to be guessed. It should be a calculated decision based on your account size and your personal risk tolerance, a topic we'll explore more when we discuss full trading plans. For now, understand that this units box is your throttle. It controls the power and the exposure of your trade. Once your direction is chosen and your size is set, the simplest way to enter the market is with a market order. This is the big buy or sell button. Clicking this tells OANDA, I want in right now at the best available price. It's immediate. It's decisive. If you see a setup happening in real time and you want to act on it instantly, the market order is your tool. The trade is executed within moments, and you are officially in a live position. But entering the trade is only half the equation. Frankly, it's the less important half. The moment you place that market order, you must also define your exit strategy. This isn't something you figure out later. You define it now. This is where the take profit and stop loss levels come into play, and they are arguably the most important tools at your disposal. A stop loss is your safety net. It's an order you place at a specific price level below your entry for a buy, or above your entry for a sell. If the market moves against you and hits this price, OANDA automatically closes your position. This is how you manage your downside. You are predefining the maximum amount you are willing to risk on this single trade. You determine in a calm analytical state where your trade idea is proven wrong. A stop loss isn't a sign of failure. It's a sign of professional discipline. It prevents a bad trade from becoming a catastrophic one. On the flip side, you have the take profit. This is your target. It's an order placed at a price level where you believe your trade has reached a logical conclusion in your favor. If the market moves as you predicted and hits your take profit price, OANDA automatically closes the position, locking in the gains. By setting both a stop loss and a take profit when you enter, you create a fire and forget mission for your trade. You've defined your risk and your potential reward up front. This removes the single greatest enemy of a trader: emotional decision-making in the heat of the moment. You're not staring at the screen, panicking as the price wiggles, or getting greedy as it moves in your favor. You've made a plan and you're letting the plan work. But what if you don't want to enter the market right now? What if your analysis tells you that the best price to enter is not the current price but a future price? This is where pending orders come in, and they transform you from a reactive trader to a strategic one. You're no longer chasing the market. You're letting the market come to you. Let's start with limit orders. A limit order is an instruction to buy or sell, but only at a specific price that is more favorable than the current market price. Imagine the euro to US dollar is currently trading at 1.0850, but your analysis suggests there's a strong support level at 1.0800. You believe the price will dip down to that level, bounce off it, and then head higher. You could sit and wait for that to happen, or you could place a buy limit order at 1.0800. If the market price drops to your level, your order is triggered automatically, and you enter the trade at the price you wanted, potentially catching the very bottom of a move. You're buying on a pullback. Conversely, a sell limit works the same way but in reverse. If the price is at 1.0850 and you think it will rally up to a resistance level at 1.0900 before falling, you can place a sell limit at 1.0900. You're planning to sell at a higher, better price than what's available now. Limit orders are about getting a better price. Then we have stop orders, which can be a little counterintuitive at first but are incredibly powerful. A stop order is an instruction to buy or sell, but only when the price reaches a level that is less favorable than the current price. Why would you want that? Because you're trading breakouts. Let's use our euro to US dollar example again, trading at 1.0850. You've identified a powerful resistance level at 1.0880 that has held the price down multiple times. Your theory is that if the price can finally break through this level, it will trigger a flood of new buying and the price will surge higher. You can place a buy stop order at say 1.0885 just above that resistance. Your order will only execute if the price breaks out to the upside. You're not trying to pick the bottom. You're trying to jump on board a moving train once it has confirmed its direction. A sell stop is the opposite. If you see a key support level at 1.0820, you might place a sell stop at 1.0815. Your thinking is that if the price breaks down through that support, it will likely continue to fall significantly. Your order only triggers if the breakdown happens, getting you into the move as the momentum shifts downwards. These pending orders buy limit, sell limit, buy stop, and sell stop are your tools for setting traps. They allow you to implement your trading plan with precision without having to be glued to your screen 24/7. But OANDA offers one more layer of dynamic risk management: the trailing stop. This is a brilliant tool. A standard stop loss is static. You set it at a price and it stays there. A trailing stop is a dynamic stop loss that automatically follows your position as it moves into profit. Let's say you set a trailing stop of 30 pips. If your trade moves in your favor by 30 pips, your stop loss automatically moves up to your entry point, making it a risk-free trade. If the trade moves another 10 pips in your favor, your stop loss follows it, moving up 10 pips as well, locking in that profit. It always maintains that 30 pip distance from the highest point the price has reached. It acts like a ratchet. It can move up to lock in gains, but it can never move back down. If the market turns against you, your position is closed out at the highest level the trailing stop reached. This allows you to let your winning trades run to capture big moves, while still systematically protecting your profits along the way. Once your trade is live, whether placed by market or pending order, it appears in your positions window. This is your live dashboard. From here you can manage everything. You can see your open profit or loss in real time. You can click to modify the trade, allowing you to adjust your stop loss or take profit levels if your analysis changes. You can also partially close a position. If you have a trade with a large number of units, you can choose to close half of it to lock in some profit, while leaving the other half open to potentially capture more upside. And of course, you can manually close the entire position at any time with a single click. Mastering this order panel is mastering the language of execution. It's the bridge between your idea and your market exposure. It's about more than just clicking buy or sell. It's about defining your terms of engagement with the market, your entry, your exit, your risk, and your strategy, all before you ever commit a single dollar. You've analyzed the charts, you've mastered the execution. You now have live positions working for you in the market based on your plan. But how do you track your overall performance? How do you review your trade history, analyze your results, and generate reports to learn from your wins and your losses? That's about looking at your account history and analytics, the pilot's logbook that tells the story of your trading journey. And that's exactly what we're breaking down next. Navigating the markets without a detailed logbook is like flying a plane through a storm with no instruments. You might get through it, but you won't know how you did it, and you certainly can't repeat your success or avoid your past mistakes. This section of the OANDA platform is your instrument panel, your flight recorder, and your post-flight analysis all rolled into one. It's where the real learning begins. Let's start with the most fundamental piece of this puzzle: your account history. This is the raw data, the chronological story of every single position you've opened and closed. Accessing it is straightforward, typically found under a tab labeled History or Account History. When you open it up, you're presented with a table, and at first, it might look like a simple spreadsheet of wins and losses. But it's so much more than that. Each row is a decision. Each column is a piece of the story. You'll see the essentials: the ticket number, which is the unique identifier for each trade; the open and close times, telling you exactly when you entered and exited the market; the symbol showing which instrument you traded, like Euro to US dollar or XAU/USD for gold. You'll see the trade type, a buy or a sell, and the volume or lot size, which tells you the size of your position. Then you get to the numbers that define the trade's mechanics: the open price, the close price, and where you placed your stop loss and take profit levels, if you used them. Finally, you see the financial outcome: any swap fees for holding the position overnight, any commissions paid, and the big one, the net profit or loss. This is your ground level view. The first step in any analysis is simply to review this raw data. But scrolling through hundreds of trades is inefficient. That's why the filtering tools are your best friend. You can typically filter this history by a specific date range. Want to see how you did last week? Or last quarter? A couple of clicks and you have your answer. You can also filter by a specific instrument. Maybe you want to analyze only your trades on the S&P 500. Filtering allows you to isolate that data and see a clear picture of your performance on that specific asset. This is how you move from a cluttered mess of data to focused, actionable information. You don't try to analyze everything at once. You break it down into manageable pieces. Now, here's a critical distinction that trips up many new traders: the difference between your trade history and your transaction history. They sound similar, but they tell two very different parts of your financial story. Your trade history, which we've just been discussing, is focused purely on your trading activity. It shows the results of your closed positions, the wins and the losses. It's your performance report card. Your transaction history, on the other hand, is the complete financial ledger of your account. It records every single event that moved money in or out. This includes your deposits and withdrawals. It includes the profit or loss from each closed trade, but it also itemizes things like swap fees, commissions, and any other account adjustments. Think of it this way. If your trade history is your batting average in baseball, your transaction history is the entire team's accounting book, showing ticket sales, player salaries, and concession stand revenue. To understand the true financial health of your account, you need to look at the transaction history. It gives you the complete, unfiltered picture of every dollar that has moved. Understanding your history is one thing, but documenting it is another. This is where generating account statements or reports comes in. This is an absolutely vital practice, not just for performance review, but for record-keeping and tax purposes. OANDA provides a simple way to generate these reports, often allowing you to specify a custom date range and export the data into a file, like a PDF or an HTML document. A PDF statement is a clean, official-looking document that's perfect for your financial records. It's a snapshot in time that you can save, print, and file away. This can be incredibly useful when it comes time to do your taxes, providing a clear, itemized list of your capital gains and losses for the year. Having these organized reports can make a potentially stressful process much smoother. An HTML report might be more interactive, sometimes allowing you to sort columns or view data in your web browser. The key takeaway is to get into the habit of regularly generating and saving these reports. It's professional-level discipline for your personal trading. But let's be honest, looking at lists of numbers is only half the battle. The real magic, the part that can genuinely shape your future trading, is in performance analytics. This is where we move beyond what happened and start asking why it happened and how we can improve. This is the process of turning raw data into trading intelligence. Many platforms, including OANDA, offer built-in tools or analytics sections that distill your trading history into key performance metrics. These metrics are the vital signs of your trading strategy. Let's break down some of the most important ones you should be looking at. First, the simple win/loss ratio. This tells you what percentage of your trades were profitable. It's a good starting point, but it can be deceiving. You could have a 70% win rate and still be losing money if your losses are significantly larger than your wins. That brings us to the next and arguably more important metric, your average win versus your average loss. This is the heart of your risk-to-reward management. If your average winning trade is $100 and your average losing trade is $200, you need to win more than twice as often just to break even. Conversely, if your average win is $300 and your average loss is $100, you can be wrong most of the time and still come out ahead. Analyzing this ratio in your history is a powerful mirror that reflects the true health of your strategy. Next up is the profit factor. This is calculated by dividing your total gross profit by your total gross loss. A profit factor above 1 means you've made more than you've lost. The higher the number, the more profitable the strategy has been over that period. It's a single powerful number that summarizes your overall profitability. Then there's a metric that speaks directly to your risk management and emotional fortitude: the maximum drawdown. This measures the largest peak-to-trough drop your account has experienced. It represents the biggest losing streak or single loss your account has had to endure. Why is this so important? Because it tells you the real-world risk you've been exposed to. An account that grows 50% with a 5% maximum drawdown is vastly different from one that grows 50% with a 40% maximum drawdown. The second one was a much wilder and more stressful ride. Knowing your historical drawdown helps you prepare mentally and financially for the inevitable downswings. The true power of analytics comes when you start segmenting the data. Don't just look at your overall performance. Dig deeper. Analyze your performance by instrument. The data might reveal that you're consistently profitable trading currency pairs, but you consistently lose money when you trade indices. That's not a failure. That's invaluable market feedback. It's the market telling you where your strengths are. You can also analyze performance by time. Are your best trades happening during the London session? Are you giving back profits during the New York afternoon? Our focus and decision-making abilities can fluctuate throughout the day, and your trading data will reflect that. By identifying your most and least profitable trading times, you can adjust your schedule to play to your strengths. This process of review, of digging through your history, generating reports, and analyzing the metrics, is the closest thing to a feedback loop a trader has. Every other profession has this. Pilots debrief after every flight. Surgeons conduct post-operative reviews. Athletes watch game tapes. For a trader, your account history is your game tape. It's where you see the fumbles, the touchdowns, the brilliant plays, and the unforced errors. Ignoring it is choosing to fly blind. Embracing it is choosing to learn, adapt, and evolve. It transforms you from someone who just clicks buttons into a strategist who makes data-informed decisions. So we've mastered the platform, from analyzing charts and placing trades all the way through to conducting a deep-dive postmortem on our performance. We know how to operate the machinery, but what if you want to modify the engine? What about taking it to the next level with advanced tools, automation, and integrating third-party platforms that can supercharge your strategy? That's the final frontier, connecting OANDA to the wider world of trading technology. And it's where we're headed in our final part of this series. This connection, this bridge between OANDA's powerful core and a universe of custom tools, is built on something called an API, an application programming interface. Now, don't let the technical name intimidate you. Think of an API as a universal translator or a secure messenger. It allows different pieces of software to talk to each other in a standardized, safe way. For a trader, this is the key that unlocks a level of customization and automation that simply isn't possible from within a single self-contained platform. It's how you tell OANDA's trading engine what to do, without ever having to log into their web platform. You can send orders, get real-time price data, manage your positions, and pull historical account information, all from an application you've built or a third-party service you've connected to. OANDA provides what's known as a V20 REST API. Again, more technical terms, but the concept is simple. REST is just a set of rules that makes it incredibly reliable and widely compatible with modern programming languages. Whether you're a developer using Python, Java, or C#, or just a trader wanting to connect a pre-built tool, this standardized approach makes it possible. This is the ultimate sandbox. It allows sophisticated traders and developers to build completely custom trading bots, create unique analytical dashboards, or run complex backtesting simulations on their own computers using OANDA's data and execution. It's for the trader who has a very specific strategy, one so unique that no off-the-shelf tool can quite capture it, and they have the technical skill to build it themselves. But what if you're not a programmer? What if you don't want to write a single line of code? This is where the true power of OANDA's open ecosystem comes into play for the vast majority of traders. Because they have this robust API, other world-class platforms can plug directly into OANDA. This means you can use the charting, tools, and interface you love most, while still benefiting from OANDA's execution, pricing, and regulatory standing in the US. Let's start with the titan of charting platforms, TradingView. Millions of traders live on TradingView for its incredibly fluid charts, its massive library of community-built indicators, and its powerful Pine script language for creating custom studies and strategies. The great news is, you don't have to choose between TradingView's interface and OANDA's execution. You can have both. Inside TradingView, you'll find a trading panel at the bottom of your screen. When you open it, you'll see a list of brokers that can connect directly. OANDA is right there on the list. You simply select it, enter your OANDA account credentials through a secure pop-up, and authorize the connection. And just like that, the game changes. Your OANDA account is now fully integrated. You can see your OANDA balance, your open positions, and your working orders, all within the TradingView interface. You can place market orders, limit orders, and stop-loss orders directly from a TradingView chart. And those orders are sent instantly to OANDA's servers for execution. You can drag your stop-loss and take profit levels visually on the chart, and it will modify your live order with OANDA. This creates a seamless workflow. You perform all your analysis on what many consider to be the best charting package in the world, and when you see an opportunity, you can act on it with a single click without ever leaving the screen. You can use TradingView's strategy tester to backtest an idea using their Pine script, and if it looks promising, you can execute the resulting trades in your live OANDA account from the same window. It's the best of both worlds, and for many traders, This integration alone is a massive reason to consider the platform. Next up is another legend in the retail trading space, MetaTrader 4, or MT4. For over a decade, MT4 has been a go-to platform, especially for those interested in automated trading. Its popularity has created a colossal ecosystem of developers and vendors who create automated trading robots, known as expert advisors or EAs, and thousands of custom indicators. Many traders have spent years learning the MT4 platform and have invested in tools specifically for it. OANDA recognizes this and offers full MT4 integration for US clients. You can download an OANDA-branded version of MT4, log in with your account credentials, and you're ready to go. This opens the door to that entire world of MT4 automation. If you've purchased an EA or have developed one yourself, you can run it on your OANDA account. You can leverage MT4's built-in strategy tester, which many algorithmic traders are deeply familiar with. You get the familiar MT4 interface and its specific workflow, but your trades are being executed through OANDA's pricing engine. This flexibility is key. OANDA isn't forcing you into one specific box. They're providing the core brokerage service, the execution, the liquidity, the regulatory compliance, and giving you the choice of which cockpit you want to fly the plane from. Whether it's their own modern web platform, the charting powerhouse of TradingView, or the automation-focused classic MT4, the choice is yours. Beyond these two giants, the API allows for connections to other specialized platforms as well. Software like multicharts and other institutional-grade platforms often have modules that can connect to brokers via an API. For the highly advanced quantitative trader, this means they can plug OANDA into their sophisticated modeling and execution software. The possibilities extend as far as the third-party software world is willing to go. So let's bring this all together. Why does this matter? It matters because it shows a philosophy. A broker that invests in and maintains a high-quality, open API is a broker that is confident in its core offering. They're not trying to lock you into a closed system. They're saying, here is our world-class pricing and execution. Access it however you see fit. This approach caters to every level of trader. The beginner can start and stay on the clean, user-friendly OANDA web platform. The intermediate trader who loves analysis can graduate to the TradingView integration. And the advanced or algorithmic trader can connect via MT4 or build their own custom solution with the API. The platform grows with you. And with that, we've reached the end of our journey. Over these 10 parts, we've gone from the very first step of understanding OANDA's place in the US market, to opening an account and navigating the nuts and bolts of the platform. We've explored the web and mobile interfaces, dissected the powerful charting tools, and detailed every single order type you can place. We've uncovered the advanced features like technical analysis from AutoChartist and the robust news and research tools. And now we've seen how OANDA connects to the wider trading world, offering a level of flexibility and power reserved for serious traders. Our goal was to give you a complete, unbiased, and incredibly detailed walkthrough, leaving no stone unturned. We wanted to move beyond a simple review and create a comprehensive educational resource that you can come back to time and time again. Trading is a field where details matter immensely, and understanding your primary tool, your trading platform, is one of an essential foundations for building any kind of strategy. The path from here is yours to walk. The next logical step isn't to jump in with real capital, but to take everything you've learned and apply it in a risk-free environment. Open a demo account. It's free, and it uses the exact same platform and live data feed. Click every button we've discussed. Place a trade using the one-click module. Set up a complex order with a take profit and a trailing stop. Try connecting your demo account to TradingView. The objective is to build muscle memory and true familiarity. When you're in a live market situation, you want your focus to be on your strategy, not on fumbling to find the right button. We covered the what, the where, and the how. The why and when of trading that comes from your own research, your own strategy, and your own experience. OANDA provides a powerful and regulated venue for US traders to access the global Forex markets. It combines a long-standing reputation with modern technology and a philosophy of openness. It's a professional-grade tool set. How you use those tools is what will ultimately shape your trading journey. Thank you for joining us on this deep dive. We hope this series has provided you with immense value and clarity. In the complex world of trading, knowledge isn't just power, it's your foundation. Trade smart, stay curious, and we'll see you in the next video.